get more on the investment strategy for stocks in that part of the world, let's join John Tang. He's a China strategist at UBS right here in Hong Kong.
Well, nice to be here.
Hey, John, you know, we've got people right now ignoring anything positive and accentuating the negative. Is that the case now? We've seen how the Shanghai market has been so beaten down in recent months. Is it time to be getting back in?
I think that for the H-share as well as the H-share market, now definitely is the time to go back in. If you look at Hong Kong market, for example, now they are trading, MSCI China is trading at 13 times with a 2-year CAGR of 21%. Basically, the valuation is about 7% lower than the 10-year average, while on the other side, the growth is 60% higher. So basically, the market is telling that they are not believing that there will be such a growth. But if you look at the May data, especially the export data, it's actually very, very good.
It's a phenomenal number, wasn't it?
It's a phenomenal number. I talked to a couple of the companies as well as the Costco, who is doing the shipping business. What they are looking for is that there has been some basically some margin pressure for the weaker guys, but the stronger guys are getting market share. They are getting market share not only from the domestic producers, they're also getting market share nationwide. So after, I think, the last financial crisis, what we are seeing now is actually the Chinese manufacturers getting stronger than before. And of course, the export data partly show that.
It's just definitely a buy signal, isn't it? I mean, but it depends whether you believe that the economy then may be overheating with such a strong number as well.
I think that the concern mainly is coming from the West, which is the Europe as well as the U.S. and now particularly Europe. People worry that whether there will be some contingent effect with Europe, which may have a negative impact on the fund flows. Remember that for the Hong Kong market, the most important thing on the one side the valuation, but on the other side is also the momentum, the fund flow from international. For A-share, this year the fund flow seems to also to be not that good. There are a lot of the IPOs to go and a lot of those refinancing to go. I think that these things need to be somehow completed before the investor will have the confidence that to come back to the market.
Of course, you can't just say broad brush stroke, everything's going to be hunky-dory here. Looking at some of the specific industries, what's going to outperform, do you reckon?
I think that for the banking industry, if ABC's IPO is proceeding relatively smoothly.
We should tell people Agricultural Bank of China, yes.
Agricultural Bank of China is proceeding smoothly. I think that this is actually a quite nice sector. They're trading like single-digit PE with 25% growth for this year, another 19% growth for next year. For large cap sectors like this, at least the valuation looks very attractive. And on the other side, as long as the NPL ratio is not going up, I think banking sector is definitely okay. On the other side, I think that you need to look for some technology companies, because on the one side, it's related to a lot of technology endeavors, 3G and these things going on in China. On the other side, the technology is related to the more machine usage and the less people usage. So that's also a nice sector.
John, let's just talk about, I mean, you mentioned technology, Foxconn raising wages for its workers. We're seeing other companies doing the same thing, Honda notably, even KFC. Yeah. This is something people are saying is going to be changing the shape of the Chinese economy, and it no longer will be a low-cost one, but the benefits, surely, for having a population which has got more money.
Yeah. I think that people pay too much attention to the negative side and pay too less attention to the positive side on this popping up news. Of course, the Foxconn thing is a flagship thing that is showing the change of China, but on the other side, for this year, it's not going to be too negative. 30% salary increases at the low end is going to boost consumption, especially low to mid-end consumption. The best way to boost Chinese consumption is to increase the low-end salaries. But on the other side, for the impacts of the higher salary, 30% higher salary to the industries, if you look at those truly labor-intensive industries, the index weighting is only like 2 to 3% to MSCI China. So overall, you will have much more positive on the bigger index weighting companies compared to the others.
John, great to see you. Thanks for coming in. Do come in again to see us. John Tang, the China strategist at UBS in Hong Kong.